Welcome to the Ideal Investor Show. Join us on the journey to financial success. Let's go. Hello and welcome back to another episode of the Ideal Investor Show, where I always try to bring you interesting guests, but also interesting topics, stuff that is educational, stuff that gives you some alternatives to achieve your goals, achieve the things that you desire to do. And I'm pretty sure that you're listening to our show because you're interested in investing in real estate and learning more about it and those kind of things. So one of the things today that I wanted to bring you is this whole issue related to interest rates. And I saw a quite interesting article in Business Insider describing exactly such a case. So the situation was that a couple, basically two people making really, really good income every year, and they wanted to find a way to reduce taxes. And one way to do that is obviously by investing in real estate and get tax benefits from the investment. Still, and I always preach that, and I was very glad to see that in the Business Insider article, you still want to always make a good deal. You don't want to just buy something and then realize losses in the deal. So we want to at least break even, or ideally have from day one a small amount of positive cash flow. If the amount is bigger, then the deal is even better. So why are oftentimes deals these days not really working very well? And the answer is, well, the prices have gone up for houses. The rents have gone up a little bit, but not as much as the prices. But what has really gone up 3 or 4x are the interest rates. And a lot of people had been thinking that the interest rates would start coming down as soon as the Federal Reserve is starting to lower interest rates. But the reality actually is that the interest rates for the Federal Reserve or the Fed are not really related to the mortgage interest rates. The interest rates we pay on mortgages are related to treasury bills, and those are very closely connected to how much debt a country, like in this case the United States, has. And so we are continuously increasing the debt, which means people want to be assured that they actually get paid if they buy that debt. And that's why the interest rates are still 7% for regular mortgages and about 8% for mortgages where you are the investor. So back to the original deal, how can a deal that does not normally work due to the high interest rates still function, so to speak? What are alternative and creative ways? And that's one that I wanted to bring to you today. There is a mechanism that exists already for decades and decades. It just doesn't really happen very often. And that is the mechanism called subject to. And what that basically means is that a sale of a property is subject to a certain condition. Now, this mechanism is typically coming into play when somebody has died. And now the question is, how is a property that belonged to the person who died going over to their heirs, or how can it be sold? But there's also another opportunity to apply the subject to, and that is when somebody owns a property that has a mortgage on it, and they basically have fallen behind on the mortgage. So in that case, normally the bank who gave the mortgage or the lender who gave the mortgage would say, okay, if you don't start paying based on the mortgage agreement, then we will foreclose on the property. But there is an alternative option where the owner can say, well, I want to try to sell the property instead of foreclosure, because typically when it goes in foreclosure, then there's a significant loss in value. And if you really think about it, everybody should be interested in doing it that way, because the bank doesn't want to actually own a house, especially one that is relatively low in value. The person who currently owns the house doesn't want to sell it for a really low price, because then they still might be owing a certain amount of money to the lender. And as a buyer, we would like to find an opportunity to get a house at a fair price, but especially with great lending. So in this case, in this scenario that I'm telling you about, a person was in distress, had a hard time making the payments on the mortgage. But one thing that was in their favor is that they had gotten a mortgage when mortgage rates were really low. So they had a 2.75% interest rate on the mortgage. It doesn't help you very much if you can't make the payments. But what can be great to make it a great deal if you compare it to a 7 or 8% interest rate is if we buy this property subject to the fact that we can keep this mortgage with this low interest rate. Because suddenly something that was cash flow negative can break even or even be cash flow positive when the mortgage rate is low enough. So how did this deal end up working out? The buyer bought the property pretty close to market rate price and created, before closing, something called a land trust. And he bought the property through the land trust. And that way, he could keep the mortgage, take it over basically, from the property for the 2.75% interest rate. And the reason that works is that the law or the rules say if a property title, meaning like the certificate of ownership, if you want to call it that, is transferred from a regular deed, meaning like the owner has the deed within their name, to a land trust, the lender cannot say, okay, the house has been sold, because a transfer to a family trust or a land trust is not considered a sale. And so here we are, the end result. The buyer bought the house pretty close to market rate. The seller was able to get the money that they were owing the bank out of the deal and pay the late fees and everything back to the bank. Due on sale clause wasn't triggered because the title is now with the land trust, and the new owner can now rent the house at a reasonable rent and make a tiny little bit of positive cash flow out of it because the interest rate is 2.75% instead of 7.5%. So everybody wins, but this is a really creative way. What's important to know is not only that this creative way exists, but it's also important to realize that the steps to make this deal work and not run into any trouble require some help and a particular sequence. Things have to happen in a certain sequence. If you break the sequence, then you might have tax implications or you cannot transfer the mortgage or anything like that. So it's a really creative way to make a deal and get this day and age where interest rates are so high, get a deal at 2.75 or 3.5% interest when everybody else who wants to buy a property pays double. Now, these deals are not, a dime a dozen. They are pretty rare to find. But if you really want to be creative on finding a deal that works well in an area that would maybe otherwise not work out or not pan out, this would be one way to go in a creative approach. So I hope that was educational. Now, again, like I said, I give you a little warning. If you're actually intrigued now and you're interested to try something like that, then please reach out. I can help you, but even if you reach out to me and you have a special case, I can refer you to people who do this kind of stuff all the time. Please be careful not trying to do it yourself because it is pretty complicated and you don't want to make mistakes when the stakes are high. So that's it for today. Be well and stay safe, and I talk to you tomorrow.